So listen, so far we are done with 3 chapters: cost of capital, capital structure, and leverage analysis. We are starting with the 4th chapter, ratio analysis. So listen, in this chapter, totally there are 59 questions. First 36 questions are concept analyzer. We will quickly go through those 36 questions and then we will start exam type questions, which includes your study material questions as well as questions from your past papers. Probably we should be able to finish this chapters by tomorrow, right? So what do you mean by ratio? What do you mean by ratio? You had it in foundation also, right? So ratio is nothing but the comparison of two numbers. So in financial management, we are going to take two numbers from the financial statements and then we are going to compare it. For example, we have current asset information and current liability information in the balance sheet. We are going to take current asset and compare it with current liability, and what that ratio is known as? Current ratio, right? So ratio is nothing but we are just going to take two numbers from the financial statement and we are going to compare it. In your exams, mostly they will not ask you to calculate the ratios. Instead, ratios will be directly given in the question. The requirement of the question will be to prepare income statement and balance sheet, right? So now ratio can be expressed in the form of percentage. For example, gross profit margin, net profit margin. So whenever the term margin is coming, it is expressed in terms of percentage. Ratio can be expressed in terms of proportion as well, like current ratios is expressed in terms of proportion. Even debt equity ratio is expressed in terms of proportion sometimes. Fraction is nothing but 1/10 or 2/4 or sorry, 1/3, which is nothing but, for example, your total asset is, let's say, 10 rupees, and let's say your debt is 1 rupee. It means that for every 10 rupee of invested in the asset, 1 rupee came in the form of debt and remaining 9 rupees in the form of equity share capital or preference share capital. And some ratios are measured in terms of times, like interest coverage ratio. I think yesterday also we discussed interest coverage ratio, right? Yesterday also we discussed interest coverage. Keep the door open, don't close it. So listen, yesterday also we discussed interest coverage ratio. What is the formula for calculating interest coverage ratio? EBIT divided by interest. So interest coverage ratio of 5 times, it means that your EBIT is 5 times greater than your interest expenses. So certain ratios are measured in terms of percentage, proportion, fraction, times, and there is also one more way of expressing ratios, that is days. Certain ratios are measured in terms of days. So that we will discuss as we proceed in the chapter. So ratios can be broadly classified into 4 major types: liquidity or short-term solvency ratio, solvency or long-term solvency ratio, activity ratio, and profitability ratios. So in this chapter, we are going to discuss each of the ratios in detail. We are going to start with liquidity or short-term solvency. What do you mean by liquidity? The ability of an asset to be converted into cash within a short period of time, right? So liquidity ratios are short-term ratios. So short term here it refers to less than 1 year. So liquidity ratios measure whether a company will be able to pay its short-term commitments from cash or cash equivalents or not. So what are all the short-term commitments for an organization? They have to pay their creditors. They have to pay their bills like electricity, telephone, accounts payable. So these are all the short-term commitments for an organization. Liquidity ratio measures whether the organization is having sufficient amount of cash and cash equivalents to pay off these short-term commitments or not. Cash equivalence includes any asset which can be converted into cash within a period of 1 year. It includes your cash, cash equivalents and bank balances, inventory, receivables and marketable securities, right? So liquidity ratios can be further classified into current ratio, quicker asset test ratio, cash ratio and defense interval ratio. Actually, defense interval ratio or interval measure ratio, it is not an actual ratio. It is something which is measured in terms of days. And the first two ratios are extremely important because these two ratios are frequently tested in your exam. So far, third ratio and fourth ratio, it was not very much tested in your exam. And even the study material questions that we are going to discuss, they do not have these two ratios, right? So first current ratio, you all know, right? So what is the formula for calculating current ratio? Current asset by current liability. Current ratio is equal to current asset by current liability. For example, let's say current asset is equal to 2 lakh and current liability is equal to 1 lakh. So how do we express this ratio? 2:1. And what does it mean? How to interpret this ratio? For every 1 rupee of current liability, there is a current asset of 2 rupees. It means that the company has sufficient amount of current assets to pay off their current liability. Clear? And one more thing, see, listen, for every ratio, I have given meaning, objective, components, all these things. We don't need to, I'm not going to read it line by line, but after discussing and after solving questions, while revising, if you just go through it, you will be able to understand it. Okay. So I'll just go through some points to remember, which is important from exam perspective, because you all know what is included in current asset and current liability, right? So I don't need to explain it again and again. So certain points to remember is, first, whenever there is a provision for doubtful debts given in the question, and if you are calculating a liquidity ratio like current ratio or quick ratio, provision for doubtful debts should be subtracted from the total receivables. Logic is very simple. In liquidity ratio, what we are measuring? We are measuring the ability to pay the current liabilities. Provision for doubtful debts is something which you are expecting to receive or expecting not to receive. You are expecting not to receive. So if you are not receiving something, you cannot use it for your payment purpose, right? So that is the reason why provision for doubtful debts should be subtracted while calculating liquidity ratios like current ratio and quick ratio. Is the logic clear? So while calculating any liquidity ratios, provision for doubtful debts needs to be subtracted. Clear? Did you all understand why we are subtracting it? Any doubt on this? I'm not getting your point. That's a short-term provision. Correct. No, this is not a liability. Provision for, provision for doubtful debts, provision for taxation, provision for depreciation. These are all not liabilities. These are contra assets, which will be deducted from the value of the receivables or assets. So for example, let's say you're having trade receivables. Let's say 1 lakh. Your provision for doubtful debts is, let's say 20,000. You will subtract it from the value of trade receivables. This is not a liability. Provision for doubtful debt, it is a contra asset. Provision for taxation, it's a contra liability. These are not liabilities actually. These are contras. Sorry? I'm not getting you. Depreciation? It is deducted from the asset value. It is not shown on the liability side of the balance sheet. Provision for doubtful debt, it is a contra asset. It is not a liability itself. Contra asset is something which brings down the value of the asset. Provision for doubtful debts is not a liability. To whom you are going to pay this? There is no obligation. Correct. That is not provision for doubtful debts. That is a provision made for other contingencies. That is not provision for doubtful debts. Right? Provision for doubtful debt is a contra asset. It is not a liability. Clear? Any doubt why we are subtracting provision for doubtful debts? Is that clear? Next. And one more important thing. The formula for working capital, we know that current asset minus current liability. While calculating liquidity ratios, sometimes working capital will be given. With the help of that, you can calculate either current asset or current liability, right? So now interpretation, you all know, I'm not explaining it. You all know. So I'm not spending much time on the ratios that you already know, right? So question number one. So what is the current ratio here? 2 times. So what does it mean? It means that for every 2 rupee of, sorry, for every 1 rupee of current liability, there is a current asset of 2 rupees, right? Now look at question number two. The ratio of current asset is 3 lakh and current liability is 2 lakh. So current ratio is nothing but 1.5 is to 1. 3 lakh divided by 2 lakh. The company wants to maintain a current ratio of 2 is to 1 by paying some part of the current liability. So listen, in this question, the company wants to increase the current ratio or decrease the current ratio. Increase the current ratio. So to increase the current ratio, there are two options. Either you have to increase your current asset or decrease your current liability. In this case, the company is planning to increase the current ratio by decreasing their current liability. By paying some part of current liability means current liability will increase and therefore current ratio will increase. I hope it is clear, right? You are required to calculate the amount of current liabilities which must be paid for this purpose, which means existing current ratio is 1.5 is to 1. In order to bring the current ratio to 2 is to 1, how many rupees of current liability the company should pay? 1 lakh. So question number 2, I'll solve it quickly. So current ratio is equal to current asset by current liability. Now what is the desired current ratio for the company? It is 2 is to 1 is equal to, what is the existing current asset? It is 3 lakh rupees. If you are paying current liability, it will decrease your asset or increase your asset? It will decrease. So we don't know the amount. We are assuming it as X divided by, if you are paying the current liability, it is again going to decrease the current liability. Existing current liability is 2 lakh. So we will take it as X. So solve it for X. How much do we get? So X is equal to 1 lakh. So if the company is paying 1 lakh rupees of current liability, their current ratio will become 2 is to 1 because, yes, got it. Any doubt in this? So now if 1 lakh rupee of current liability is paid, current asset will become 2 lakh and current liability will become 1 lakh. Now what is the current ratio? 2 is to 1, which is the desired current ratio. I hope it is clear, right? Did you all understand? Next question number 3. Listen, a firm had a current liability of 90,000. It then acquired stock in trade at a cost of 10,000 on credit. So what is this 10,000 basically? Stock in trade is nothing but inventory. You are purchasing this inventory on a credit basis or on a cash basis? Credit basis. So it will increase your current asset as well as your current liabilities. After this acquisition, current ratio was 2 is to 1. Determine the size of the current asset. Determine the size of the current asset and working capital after and before the inventories were acquired. So we have to calculate what is the amount of current asset and working capital before acquiring the inventory and after acquiring the inventory. Did everyone get that answer? 1,90,000? Everyone? Is there anyone who wants me to solve it? Did everyone get the answer? Okay. So listen, existing current liability is 90,000, which is given, but current asset, existing current asset is not given. And after acquisition, the current ratio became 2 is to 1. So current ratio after acquisition, it is equal to current asset. We don't know. We are assuming it as X plus after purchasing an inventory worth of 10,000 rupees, current asset will increase by 10,000. So X plus 10,000 rupees divided by existing current liability was 10,000, sorry, 90,000. On top of that, we purchased inventory on credit basis. So that will further increase the current liability by 10,000. So plus 10,000. So current ratio is 2 by 1 is equal to X plus 10,000 divided by 1 lakh. So now what is the value of X, which is nothing but the existing current asset? Current asset existing is how much? 1 lakh. Sorry, this is new, right? Or existing. This is 1,90,000 is the existing current asset. Correct. Did everyone understand this point? Right. So before acquisition of inventory, it was 1,90,000. So current asset after acquisition will become 1,90,000 plus 10,000. It will become 2 lakh rupees. Clear? Now, what is the working capital before acquisition? Working capital is equal to current asset minus current liability. Before acquisition, we had a current asset of 2 lakh rupees. Sorry, 1,90,000. Sorry. Before acquisition, we had current asset of 1,90,000 and we had a current liability of 90,000. So before acquisition, working capital is 1 lakh. After acquisition, current asset is 2 lakh. Current liability is 1 lakh. So after acquisition also working capital is 1 lakh rupees. Is it clear? Any doubt in this? Now next ratio is quick ratio. So what is the formula for calculating quick ratio? Quick ratio is equal to current asset minus inventories minus prepaid expenses divided by current liability. And you all know what is the other name for quick ratio? It is acid test ratio. Now listen, quick ratio is more conservative than current ratio. Why? Because in current ratio, we were using the total current asset to pay off the current liability. But while calculating quick ratio, we are subtracting inventory. Why we are subtracting inventory? Because inventory cannot be converted into cash quickly. For example, let's say it is a raw material inventory. It needs to be converted into work in progress, then finished goods, then accounts receivable, and then finally to cash. Even if it is a finished goods, you cannot push it outside your factory if there is no enough demand in the market. So inventory is something which cannot be converted into cash quickly. So we are subtracting it. Why prepaid expenses is subtracted? Because prepaid expenses cannot be converted into cash anytime. So we are subtracting it. I hope it is clear, right? So let's directly go to the numericals. Question number 4, calculate the quick ratio and tell me quickly. Quick ratio is how much? 1:1, right? Current asset minus inventories minus prepaid expenses divided by current liability. You get 1:1, which means for every 1 rupee of current liability, there is a quick asset of 1 rupees. Clear? Any doubt in this? Now listen, question number 5. X Limited has a current ratio of 4.5:1 and quick ratio of 3:1. If inventories are 36,000, find out its total current assets, total current liabilities and quick assets. So look at question number 5. First current ratio is given, which is nothing but current asset by current liability. So current ratio is 4:4.5:1. So 4.5 by 1 is equal to current asset by current liability. So we can write the equation as current asset is equal to 4.5 times of current liability. So write it as equation number 1. Next, it is mentioned in the question, quick ratio is 3:1. So quick ratio is equal to current asset minus inventory. In this question, prepaid expenses not given. So assume it as 0. So quick ratio is 3:1. So 3:1 is equal to current asset we don't know minus inventory is how much? 36,000 divided by current liability. So here we can write current asset is equal to 3 into current liability plus 36,000. So now equate, let's put it as this is equation 2. Equate equation 1 and equation 2. What is the purpose of doing it? Still 4,50,000 by 1 lakh is still 4.5 only. What? Still you will get the same answer, yes. Huh? Huh? Huh. You can do like that also. Same numbers will come. So what is the current asset and current liability by equating the equations? Current asset is 1 lakh 8,000. Current liability 72. No. 1 lakh 8,000 into 4 point, yeah, divided by 4.5. How much do we get? 24,000. Then one more requirement is to calculate quick asset. So what is the quick asset? Quick asset is nothing but current asset 1 lakh 8,000 minus inventory 36,000, 72,000. Clear? Did everyone get these numbers? Last, did you all get it? Got it? So next, absolute cash or liquidity ratio. Listen, while calculating current ratio, we were using current asset for paying current liabilities. In quick ratio, we subtracted inventories. While calculating absolute cash or liquidity ratio, we are just going to take cash and cash equivalents. That is cash in marketable securities and compare it with the current liabilities, which means we are going to ignore accounts receivable also. So look at question number 6. How do we calculate absolute liquid ratio? What is the absolute liquid ratio? It is 0.6 is to 1, which is nothing but 2 lakh plus 1 lakh divided by 5. For every 1 rupee of current liability, there is a cash and cash equivalent of 0.6 rupees. Clear? Any doubt in this? Did everyone understand? Demand, yeah, correct. It can be, yes. But in this, I mean, in your textbook, there is no question involving those things. Clear so far, first 3 liquid ratios, any doubt, right? Now listen, base defense interval ratio. You don't have this in BCom, right? Base defense interval ratio. Have it. Okay. So what is the formula for calculating base defense interval ratio? Huh? Huh? Quick assets. Base defense interval ratio. See, listen, first understand. Okay. So listen, first understand why we are calculating this ratio. Base defense interval ratio tells us with the available amount of quick assets for how many days you can meet your daily operating expenses. Again, I'm repeating, with the available amount of quick assets for how many days you can meet your daily operating expenses. So it is calculated as quick asset divided by daily average operating expenses. So just look at one question, you will be able to understand it. Question number 7. Here you're not even considering in quicker search, we will consider, yeah, correct, liquidity ratios, provision should be separate. Provision for doubtful debt, it is not a current liability, it is a contra asset. It will be deducted from the asset side of the balance sheet. It is not a liability. So listen, so for calculating base defense interval ratio, we need 2 components. First one is quick asset, second one is daily average operating expenses, right? So listen, first calculate the first component of the formula, which is quick asset. What is the quick asset? Current investment should be included or not? Quick asset, this should be included. Inventories should not be included. Trade receivables should be included. But here trade receivable is 3,50,000. There is a provision for doubtful debts of 50,000. While calculating liquidity ratios, provision for doubtful debts should be subtracted. Right? Why? Because this 50,000 cannot be used for paying your current liability. Why? Because you're not expecting to receive it. You can't pay, you can't use this 50,000 for payment if you're not receiving it, right? So quick asset includes current investment, trade receivables, minus provision for doubtful debts. Cash and cash equivalents will be included or not? Yes. So what is the total quick asset? 6 lakhs. So quick asset is equal to 6 lakh rupees. Is this clear to everyone? Any doubt? Daily average operating expenses. So listen, for calculating your average daily operating expenses, you have to take cost of goods sold plus other operating expenses, and you have to subtract non-cash expenses like depreciation, amortization. All these non-cash expenses should be subtracted, right? So what is your daily expenses? COGS 8 lakh plus 50,000 minus 1 lakh 20,000. How much do we get? 7 lakh 30,000. So total operating expenses is 7 lakh 30,000. But we need to calculate the daily average expenses. Assume 1 year has 365 days. So for 365 days, it is 7 lakh 30. Then for 1 day, how much it will be? How much? 2,000. So this is your daily average expenses. Average daily operating expense. 2,000. Is this clear to everyone? Any doubt in this part? Did everyone understand it? Right? So quick asset of 6 lakh divided by 2,000. How much do we get? How much? 300. With the available amount of quick assets, you can pay your operating expenses for the next 300 days. Or to put it very simple, quick assets are sufficient to pay your operating expenses for the next 300 days. Is this clear? Did you all understand how to interpret it? Any doubt in this? Sorry? Trade investments are purchased with an intention to sell it in the immediate short term. So it is a current investment only. Not long term. No way. See, it is a fair value through P&L. Fair value through P&L means it is a trading security, which is for short term. Okay, fine. Leave it. I don't want. Sorry? Question or answer? Who's taking BCom FF? Done. So listen, if I go in the space, is it fine for everyone? I know that I'm going very fast. Is it fine? Okay. So listen, liquidity ratios are nothing but short-term solvencies. Solvency ratios are nothing but long-term liquidity. In liquidity ratios, we discussed whether we are having sufficient amount of current assets to pay the current liabilities. In solvency ratio, we are going to measure whether we are generating sufficient amount of profit and cash to pay off our long-term liabilities or not. Right? Solvency ratio can be broadly classified into capital structure ratios and coverage ratios. So first, let's start with capital structure ratios. Listen, for all the capital structure ratios, the interpretation is almost same, right? So first, debt equity ratio. It establishes a relationship between debt and equity shareholders fund. So here, what is important is the formula for calculating debt and equity depends upon the information available in the question. So these are all the different formulas that can be used for calculating debt and equity, right? To put it very simple, listen, while calculating solvency ratios, The debt includes only long-term debts like long-term borrowings, debentures, and what else? Long-term loans taken by the company. It does not include any current liabilities or short-term loans. Similarly, while talking about the equity share capital, it includes both equity share capital as well as the reserves and surplus of the company here, right? Why? Because listen, here we are not going to take the market value. If we are taking market value, the share capital includes what? Retained earnings. But here we are going to calculate ratios based on book values. So the share capital does not include the retained earnings. So it has to be taken separately, right? So equity includes equity share capital as well as reserves and surplus. So now we will do this interpretation along with the question. Listen. So what are all the components involved in calculating debt to equity ratio? Numerator is debt, denominator is equity. So we have to calculate debt as well as equity. So I'll just quickly do it over here itself. So debt includes equity share capital will not be included. Preference is not a debt. Reserves and surplus is not a debt. What is the only debt that we are having in this question? Long-term borrowings of rupees 8 lakhs. Now, what is the equity of the company? Equity includes equity share capital as well as reserves and surplus. Equity share capital is 2 lakh rupees. Reserves and surplus is 2 lakh rupees. So total equity is 4 lakh. So what is your debt to equity ratio? 2:1. What does it mean? It means that for every 1 rupee of equity, there is a 2 rupee of debt. So the company is using more debt or less debt? More debt. More debt means high leverage or low leverage? High leverage, right? Is this clear? Any doubt in this? For every 1 rupee of equity, there is a 2 rupee of debt in the company, which means the company is using more debt than equity. So it is a highly risky company because leverage is high. Clear? Any doubt? Ninth question you try. Just try to calculate it because these kind of workings we will do while solving the actual questions. Ninth question you try to solve it and tell me the answers. Debt equity ratio. Zero point two. Oh, wait. 0.2. 0.2. Oh, 2:1. 2:1. 2:1. So listen, in this question, asset test ratio, which is quick ratio is given and current ratio is given. So first, did you all calculate current asset? Did everyone calculate current asset? What is the current asset value? 2 lakh. Okay. So current asset is 2 lakh. Listen. Huh? Huh? No, no. You have to calculate debt to equity ratio. Asset test is given. Did you calculate current asset? How much? 2 lakh. Okay. Did everyone get current asset 2 lakh? Everyone, right? So question number 9, current asset is 2 lakh. And we have a non-current asset of how many rupees? Non-current asset is 1,80,000. So non-current asset is equal to 1,80,000. So what is the total asset? It is 3,80,000 rupees. Right. Now debt to equity ratio. Total debt is given as 2,80,000. What is the current liability you calculated? 80,000. So now listen, in this question, total debt is given 2,80,000, which includes your current liability as well as non-current liabilities, right? So for calculating debt to equity ratio, we need current liability or non-current liability or both. We need only non-current liability, right? So non-current liability is equal to total debt of 2,80,000 minus current debt of or current liability of 80,000. What is the non-current liability? 2 lakh. Till this point, is it clear to everyone? Any doubt in this? Did you all understand? Right. Now listen, what is the total asset of the company? 3,80,000. Out of that, total debt is 2,80,000. So what is that remaining 1 lakh? What is that remaining 1 lakh? Has to be your equity, right? So equity is nothing but total asset minus total liability. So equity is equal to 2,80,000 minus, sorry, 3,80,000 minus 2,80,000. Equity is equal to 1 lakh. So what is debt to equity ratio? 2:1. Did everyone get it? Any doubt in this? No, preference will be added in proprietary funds. They don't mean. There is a shareholders fund and equity shareholders fund. Equity shareholders or fund includes only equity share capital and reserves and surpluses. That is then there's one more ratio called proprietors fund. Their preference shareholders fund will be included, not in debt equity ratio, because debt preference is neither debt nor equity. It is a compound instrument. Huh? Reserves and surplus include. Listen, till this point clears. You got it, Vaibhav? You got the answer? Doing what is there to do? Listen, is there any point that you want me to explain? I will explain it. Total asset minus total asset minus non-current liability. If you are taking that, it will give you current liability plus equity share capital. We want only equity, not current liability itself. Listen, balance sheet side, we have equity, non-current liability, current liability. Non-current liability, how much given in the question? No, 2,80,000. Current liability, how much? 1 lakh. Sorry, 80,000. Wait. Sorry. Listen, current liability 80,000. Total debt is 2,80,000. So non-current liability is 2 lakh. Current liability 80,000. Total asset is 3,80,000. So what will be equity? This side also it should be 3,80,000. So it is 1 lakh. Understood? Huh? Understood now. Listen. Listen. Is it clear to everyone? Shall we move to the next question? Is there anyone who did not get these answers? From the last, you all got it. Now listen, debt to total asset ratio, similar kind of ratio. Listen. Debt to total asset, the formula is debt divided by total asset. So this ratio tells us how many portion of the total asset is financed using debt, right? So remaining portion is financed using either preference share capital or equity share capital. So debt to total asset ratio establishes a relationship between debt and total asset. So it tells us how many rupees of the total asset is financed using long-term debt of the company, right? So again, there are different formulas for calculating debt, different formulas for calculating total assets, which needs to be used based on the scenario, right? And most importantly, listen, total asset do not include fictitious assets. What are fictitious assets? Examples, can you give me some? Goodwill is not a fictitious asset. Goodwill is an intangible asset. Deferred revenue expenditure, then prepaid is a current asset. Fictitious assets, deferred revenue expenditure, then preliminary expense is a fictitious asset. Accumulated loss, it is a fictitious asset. So these are all some fictitious assets. These assets will not give or it will not generate any revenue for the company. Actually, these are expenditures that are shown on the asset side for a temporary period of time. Intangible assets are not fictitious assets. Fictitious assets are those assets that do not generate any benefit or revenue for the company, like preliminary expenses, deferred revenue expenditures, and all. Right. So those fictitious assets should be excluded while calculating total assets. Right? So we will do the interpretation after solving the 10th question. Listen, question number 10. So what do we need to calculate here? Debt to total asset. What is the formula? Long-term debt divided by total asset. So first component, what are all the items that will be included in the debt? Equity share capital, no. Preference, no. Reserves and surplus, no. Long-term borrowings of 8 lakhs should be included. Current liability, yes or no? No, because we are dealing solvency ratios. We have to take long-term liabilities, not current liabilities. Divided by what is the total asset? Fixed asset of 9 plus 150, 1050 plus 11 plus 16 lakh. So it is 1:2. So how do we interpret this ratio? Listen, for every 2 rupee of asset, for purchasing 2 rupee of asset, 1 rupee came in the form of debt, remaining in the form of other source of finance. It could be equity or preference. Or to put it very simple, 50% of the total asset is financed using debt and remaining using other sources of finance. Is it clear? Any doubt in this? Clear to everyone? We are dealing with solvency ratios. Here we are talking only about long-term borrowings. Here we have to include current liabilities only for liquidity ratios. Solvency ratios or long-term liquidity. So that is what we discussed over here. Long-term financial solvency of the company. Current liabilities are used to meet your, current liabilities are your short-term obligations. They are not your long-term obligations. So solvency ratios for, solvency ratio include only long-term liabilities, not short-term liabilities. Clear? Any doubt in this? To everyone, till debt to our total asset ratio. See, if you want me to slow in between, please do let me know. Okay. And proprietary ratio, listen. Proprietary ratio is similar to debt to asset ratio, but the only difference is in debt to total asset, what did we take on the numerators? Debt, right? So in proprietary ratio, we are going to exclude debt and we are going to take all the other sources of finance. So other than debt, what are all the sources of finance we have? Equity and preference, right? So in proprietary ratio, we have to, let me show it over here. Calculating proprietary ratio, numerator we have to take proprietors fund, which includes preference shareholders fund as well as equity shareholders fund. And we will divide it by the total asset. So this ratio tells us what portion of the total asset is financed using preference share capital and equity share capital. Clear? And here we have different formulas for calculating shareholders fund and total asset, which needs to be used based on the situation, right? We will do the interpretation with the help of this question. Calculate proprietary ratio. First, the numerator is proprietors fund, denominator is total asset. So in proprietors fund, equity share capital should be included or not? Yes. So 1,50,000 plus preference share capital. Yes. Reserves and surplus. Yes. Why? Because it belongs to equity shareholders. Long-term borrowings. No. And current liabilities. No. So what is the numerator total? 4 lakh. Total asset, how much? 16 lakh. How much? 1 is to 4. So what does it mean? For every 4 rupee of asset, there is a 1 rupee of proprietors fund in the organization. Is this clear? Any doubt in this? Any doubt so far? Did everyone understand it? Here's 1 rupee of proprietors fund. For every 4 rupee of asset, for 4 rupee of asset, there is 1 rupee of proprietors fund. So for financing 4 rupee of asset, 1 rupee came in the form of equity share capital and preference share capital. That's all. Or else let me put it in this way, you can understand it much better. Listen, question number 10 and question number 11, the numbers are same. In fact, in all the questions, the numbers are same. Only the requirements are changing, right? What is the total asset? 16 lakh, right? 16 lakh is the total asset. Out of this, what is the debt amount? Total debt? 8 lakh. Long-term debt is 8 lakh, right? So out of the 16 lakh, 25 percentage debt is used to finance this. Sorry, not 25, 50%, 8 lakh. Sorry. 50 percentage debt is used to finance this 16 lakh rupee of asset. Is this clear? Similarly, we have proprietors fund. What is the proportion of proprietors fund? Total proprietors fund, how much? How much? 25 percentage, which is 4 lakh. You're all understanding how I am getting these numbers. Any doubt? Clear? Now, 50 plus 25, how many percent? 75%. What is that remaining 25 percentage? Remaining 25 percentage is nothing but your current liability. Clear? Any doubt in this? For financing your asset of 16 lakh, we use 50% debt, 25% proprietors fund, 25% is current liability. As simple as that. Got it? Now look at the cap. Huh? Listen, next ratio is capital gearing ratio. So here in capital gearing ratio, the numerator includes everything except equity. So capital gearing ratio establishes the relationship between funds bearing fixed financial payments. So in what are all the sources of finance that bears fixed financial payment? Debt and plus preference. Right? These are all the two sources of finance where we are going to pay a fixed financial charge. One is interest, other one is preference dividend. So numerator includes debt and preference share capital, and the denominator is your equity share capital. Clear? So it establishes the relationship between funds bearing fixed financial payment and equity shareholders fund. So look at the calculation formula. It is debt plus preference share capital divided by equity shareholders fund. Right. Interpretation we will do after solving this question. So calculate the capital gearing ratio and tell me the numbers. How much it is? 3:1. And how do you interpret this? For every 1 rupee of equity, there is a 3 rupee of funds bearing fixed financial payments. So listen, if capital gearing ratio is greater than 1, we call those company as highly geared or highly levered company. Right? If the capital gearing ratio is less than 1, those companies are lowly geared or lowly levered company. Clear? Right? Any doubt in this interpretation? For every 1 rupee of equity, the company has 3 rupee of funds bearing fixed financial charges. Right? Which is nothing but, or to put it simple, for every 1 rupee of equity, there is a 3 rupee of debt and preference share capital. So this company is a highly levered company because capital gearing ratio is greater than 1. And why it is highly geared? Because the company is using more of debt and preference, less of equity. That's all. Clear? Any doubt in this? Equal proportion of debt and equity. I mean, equal proportion of fixed finance bearing fixed financial charges and equity. It is equally geared. I mean, not neither highly geared nor lowly geared. You can say the leverage is equal to 1. In such cases, DFL will be equal to 1. Any doubt in this? Clears so far? If you are feeling sleepy, please go wash your face and come. DFL is equal to 1. There will be no, if there is no interest, DFL is 0. No financial leverage, DFL is 0, right? Oh, EBIT, okay, sorry. I'm confusing. Sorry. DFL is 1. Oh, correct. Yeah, DFL is 1. There is no interest. Correct. Then 1 is to 1 is oh, correct. Makes sense. DF, then 1 is to 1 is neither highly geared nor lowly geared, but DFL won't be equal to 1. Correct. Check it. But yeah, if it is 1 is to 1, you can say it is neither highly geared nor lowly geared. The proportion of equity and funds bearing fixed financial charges are equal. That's all. So listen, next equity ratio, extremely simple. This ratio tells us out of the total capital employed, what is the proportion of equity. To put it very simple, this is nothing but in cost of capital chapter, we studied, right? Weight of equity, it is similar to that. Equity divided by total capital employed. And most importantly, listen, this is something which needs to be discussed because this will come while solving questions also. Capital employed can be calculated using two methods. One is quite straightforward. Equity share capital, preference share capital, reserves and surplus plus non-current liabilities. Other method is take total asset and subtract the current liability because current liability is not a part of long-term capital employed. It is a short-term liability. So ignore that. So these are all the two formulas that you can use for calculating capital employed, right? Now calculate equity ratio on this and tell me the numbers. Equity by total capital employed. How much do we get? Equity includes equity share capital and reserves and surplus. 3 lakh divided by total capital. How much? This plus this plus this plus this 12 lakh, right? We are getting how much? 1 is to 4. Or you can write it as 25%. Clears? Now, listen, capital employed 12 lakh. We are adding these 4 figures. Alternate formula is total asset minus current liability. Still, we will get the same capital employed, right? Now, listen, how do we interpret this? For 4 rupees of capital employed, 1 rupee came in the form of equity. Or you can say that 25% of your capital employed is equal to equity share capital. That's all. Clears? So we are done with capital structure ratios. Let's start with coverage ratio. Interest coverage ratio we did yesterday itself, right? You all remember what is the formula? It is EBIT by interest, right? So we'll directly go to the question. This interpretation we will discuss with the example. Listen, don't solve question number 14. Don't solve question number 14. Let's do 15 because both the questions are same. I have just twisted the numbers a little bit. Look at question number 15. So net profit after interest and taxes 3,60,000. So what is 3,36,000. What is this 3,36,000? Your profit after tax. There is a 15% long-term borrowings of 8 lakh rupees. Tax rate is 30%. Calculate interest coverage ratio. What is the formula for interest coverage? It is EBIT by interest. Is EBIT directly given in the question? No. So we have to calculate it. How can we calculate? Do the reverse calculation. We don't know the EBIT. This is something which we need to calculate. Minus interest. We will get EBT. minus tax at how many percentage? 30 percentage. We get EAT. Now, what is the earnings after tax given in the question? It is 3,36,000. So we don't know what is the tax rate. Listen, sorry, we don't know what is the EBT, but we know that out of this EBT, 30 percentage is gone for tax, remaining 70 percentage for earnings after tax, right? So I can say 3,36,000 is how many percentage of EBT? 70%. So what is EBT now? How much? 4,80,000 is the EBT. Did everyone understand how did we get EBT as 4,80,000? Got it? Minus tax rate is 30%. How much do we get? 1 lakh 154. Sorry, 144. Right, 144. So interest is something which we can calculate. It is 15 percentage of 8 lakh. What is the amount of interest? 1,20,000. So what is EBIT? 6 lakhs. So now we have EBIT and we have interest. Calculate interest coverage ratio. Interest coverage ratio is equal to 6 lakh by 1,20,000. How much do we get? 5 times. Clear? Any doubt in this so far? So what does it mean? It means that EBIT is 5 times greater than your interest liability. Clear? Your EBIT is 5 times greater than your interest expenses. Now look at this interpretation, everyone. You can understand it much better. Listen. For example, if interest coverage ratio is 5 times, that is what we calculated. It implies that even if the EBIT decreases by 80%, the firm will still be able to pay the interest out of profits, which means now what is the current EBIT? 6 lakh. You remove 80% of this EBIT. How much do you get? 1,20,000. Still you can pay your interest liability. Correct. So your EBIT can decrease by 80%. Still you are in a safer position. But if it decreases by 81%, you don't have sufficient amount of profit to pay your interest expenses. That's all. Clear? Any doubt in this? See, it is 5 times. No. So, 100 by 5 is your 20%. So remaining 80 is the, or you can write 1 by 5, 4 by 5. And did you all understand how did we get that 80%? Is it clear? Now, see, listen, next ratio is, before that, interest coverage ratio clear to everyone? Any doubt? Next ratio is preference dividend coverage ratio. What could be the formula for this? You tell. Profit after tax divided by preference dividend. That's all. Right? Why we are on the numerator? We are taking profit after tax because preference dividends are paid out of profit after tax. Interest is paid out of EBIT. So that is the difference. Clear? Understood? Did you all understand why we are using this formula? No. See, listen, interpretation is same. So quickly do the calculation. Same numbers. You don't even need to calculate it. Same numbers. You know the PAT, right? What is the PAT in this question? Why are you calculating? Just now we calculated. PAT, 3 lakh. Do that. 1.86. So profit after tax is equal to 3,36,000. Preference dividend is how much? 18,000. So what is preference dividend coverage ratio? 18 points. 18 point? Preference dividend is 18,000. Oh, okay, I'm correct. 18.67 times. Clear? Any doubt in this? Now listen, this is something slightly different. Listen. You're done? Till this point. Next ratio is slightly different. Listen. Debt service coverage ratio. So this debt service coverage ratio is similar to interest coverage ratio. Interest coverage ratio, what we are doing is, we are taking EBIT, comparing it with interest, and we are measuring whether we are generating sufficient amount of EBIT to pay off the interest or not. But if you are borrowing money, we are not only going to pay interest, we are going to pay principal amount on an installment basis, right? So in debt service coverage ratio, numerator is same EBIT, denominator also interest, plus we are also going to add the principal amount. So here we are checking whether we are generating sufficient amount of EBIT to pay off the interest as well as the principal installment or not. Till this point, is it clear? Any doubt? That will be given in the question. How many installments? It will be given in the question. Installments. Right. Now listen, look at question number 17. We will do the interpretation after solving it. Yeah, correct. Debenture is also borrowing. Listen. So for calculating debt service coverage ratio, what is the formula? Debt service coverage ratio. Sorry? Irredeemable, you are going to pay the principal at the time of liquidity only, no? So there is no. Sorry? No, we are not going to allocate it because we don't know the number of years if it is irredeemable. It is infinite. So there we cannot calculate debt service coverage ratio. It is for redeemable only. Listen. That is something which we will discuss. Listen. That we will discuss. Listen. I think you are using the textbook. Yeah, okay. Fine. Listen. What is the formula for DSCR? EBIT divided by interest plus principal, right? Now, what is the EBIT in this question? 8,50,000 divided by interest, how much? Interest? 70,000. What is the principal repayment that is going to happen in 1 year? 70,000. So, 70 plus 70, how much do we get? 6.07 times. So, what does it mean? It means that your EBIT is 6.07 times greater than your interest obligation and principal repayment obligation. Clear? Till this point, is it clear? Any doubt in this? Did everyone understand? Interpretation. Your EBIT is 6.07 times greater than your interest obligation and principal repayment obligation. It means for every 1 rupee of your, see, this denominator is there, no? This is totally your obligation, which is something you have to pay. For every 1 rupee of obligation, you are having 6.07 rupees of profit. Got it? For every 1 rupee of obligation, you are having 6.07 rupees of profit. So your profit is greater than your obligation. So you are in a safer position. Clear? Your performance is good. This 70,000. That's an alternative way of doing it. That is what we are going to do next. But till this point, is it clear? You are talking about the 70,000, right? No, it will not be paid before EBIT. It will be paid after EBIT. I'll tell you how it is done. Listen, this is only this is one way of doing debt service coverage ratio. There is an alternative way. Listen, debt service coverage ratio is equal to EBIT divided by interest plus this principal portion is there, no? That needs to be divided by 1 minus T. Why? Because listen, interest first, EBIT is a before tax figure or after tax figure? Before tax. Interest is paid before tax. But you are going to pay this principal amount out of profit after tax, which is paid after tax, right? This principal amount is paid on net income or profit after tax. So it is an after tax figure. So this needs to be converted into before tax for consistency purpose. This is before tax. This is before tax. This alone cannot be after tax. So we are dividing it by 1 minus T. So this is an alternative way of doing it. Now you got it. Correct. See, profit is different, cash is different. A company might incur loss, but still they may have cash. With that cash, they will pay the installment. But usually, principal amount will not give them tax benefit. Principal is not okay. You tell you are studying P&L account since your first PU. We will debit interest expense to the P&L account. Have you ever debited principal amount to the P&L account? No. So principal amount is not paid before tax. It is paid after tax. I hope now you are getting the point, right? Huh? Sorry? Interest is paid before tax. How can interest be after tax? EBIT is before tax. Earnings before interest and tax. How that can be after tax? Debt service coverage ratio is equal to, write down the alternate formula. 8,50,000 divided by interest is 70 plus principal is 70,000 divided by 1 minus tax rate is how much? 0.3. How much? 8,50,000 divided by 70 plus 1,170. 17 into 5 is 85. So 5 times, right? So 5 times is your debt service coverage ratio. For every 1 rupee of obligation, there is a 5 rupee of profit. Yes. See, actually, this is a better version of the formula. It is better to use this formula, right? And one more thing, study material, past year questions, MTPs, RTPs. So far, debt service coverage ratio is not at all tested. Okay. Let me tell you that also. You want a break? Break. This is a better version of the formula. Sorry. Wait. Listen. We'll move to the next ratio of fixed charges. Listen. See, the object, the aim is to complete this chapter before, by tomorrow. So please listen. We have class starting from 11:45, not tomorrow. Listen, fixed charge coverage ratio. Again, it is exactly similar to the interest coverage ratio, but the only difference is, listen, interest coverage ratio, we are using EBIT by interest, right? Listen, EBIT is profit, right? Profit is something which can be manipulated. So instead of using profit, we are going to use cash flow from operating activities and divided by interest. Because cash flow is something which cannot be manipulated. Cash flow is objective, profit is subjective. So instead of using EBIT, we are going to use cash flow. That is the only difference in fixed charges coverage ratio, right? And one more thing, in the denominator, it is not only interest, we are also going to add fixed financial charges, other fixed financial charges before tax. For example, you can say lease payments. Lease payments are fixed financial charges that is paid before tax. So interest on debentures plus lease payments, right? Plus fixed charges before tax. So listen, let's solve question number 18. Listen. Before tax only, no? Before EBIT means before tax only, no? Listen. Question number 18. EBIT is 8,50,000. The company is having 10% debentures of rupees 7 lakh. Depreciation 1 lakh. Goodwill return of 50,000. This goodwill return of 50,000 is a cash or non-cash item? Non-cash item. Loss on sale of fixed asset. Cash or non-cash item? Non-cash. And tax rate is 30%. Fixed financial charges other than interest is 1 lakh rupees. Calculate fixed charges coverage ratio. Listen. So here, this profit of 8,50,000 is arrived after adjusting for non-cash items like depreciation, goodwill, and loss. So what do we need to do? We have to add all these back. So what will be the cash flow from operations? 850 plus 1 lakh plus 50,000 plus 20,000. How much do we get? 10 lakh 20,000. So now calculate fixed charges coverage ratio. 10 lakh 20,000 divided by interest is how much? Interest is 70,000 plus 1 lakh rupees of other financial charges. So what is your fixed charges coverage ratio? 6 times. Is it clear? Any doubt in this? So for every 1 rupee of fixed financial charges, you have 6 rupees of what? Answer. For every 1 rupee of fixed financial charges, you have 6 rupees of what? Cash, not profit, right? Is it clear? Any doubt in this so far? Now, why 1 minus t? That is before tax. Here, look at the theory. Fixed financial charges before tax. That 1 lakh is also before tax only, not after tax. Did everyone understand this one? Any doubt in this? Clear? Huh? 850 profit plus depreciation non-cash item, goodwill written off non-cash item, loss non-cash item, add everything. That's all. 10 lakh 20,000. So next set of ratios, listen, activity or turnover ratios. So, sorry? So while preparing cash flow statement, we start with the profit, right? To the profit, first we will add all the non-cash items, correct? In this question, what is the profit? 8 lakh 50,000 is the profit. Plus depreciation is a non-cash item. Plus 1 lakh. Goodwill return of non-cash item. Plus 50,000. Plus loss on sale of fixed asset, non-cash item. Plus 20,000. If you add all this, we will get 10 lakh 20,000. Divided by, you understood the denominator, no? Now look at the next set of ratios, activity or turnover ratios. So listen, we discussed 2 set of ratios. First one is liquidity, and what is the second set of ratios? Solvency. Liquidity ratio, we measured whether we are having sufficient amount of current assets to pay off the current liabilities or not. Solvency ratio, we measured whether we are generating sufficient amount of profit and cash to pay off the what? Long-term liabilities. Activity ratio tells us, or turnover ratio tells us, how effectively we are making use of the assets to generate sales and profits. Clear? With the available amount of asset base, how effectively we are using the asset for generating sales. Sorry? Liquidity tells us whether we are having sufficient amount of current assets to pay the current liabilities or not. Solvency, whether we are generating sufficient amount of profit and cash flows to pay the long-term liabilities or not. turnover ratios or activity ratios tells us how effectively we are using the resources for generating sales and profit. So basically efficiency ratio tells us how effectively we are using the available resources. So first ratio is total asset turnover ratio. Yesterday also I told you, if the word turnover is in the name of the ratio, the numerator should be sales, right? There is an exception, only one exception for that we will discuss. But if it is a turnover ratio, the numerator should be sales. And denominator should be the first term. If it is total asset turnover, it should be sales by total asset. Capital employed turnover, sales by capital employed. So sales by total asset turnover ratio. Sorry, sales by total asset. Right. And one more important thing. Listen, on the denominator, we have to take the average total asset if relevant information is given in the question, which means if opening and closing total assets are given, it is better to take the average figure. Why it is necessary to take the average, the denominator? What is the logic behind that? So sales is a P&L figure which is incurred throughout the year or at a point of time. Throughout the year. Total asset is a balance sheet figure which is at a particular point of time. This is a figure on 31st March. On this particular day, what is the total asset? That is what measured in the balance sheet. But P&L is prepared for a particular date or over a period of time. Over a period of time. So this figure is over a period of time. This is at a point in time figure. So on the denominator also, we have to take the average if relevant information is given in the question. Is it clear? Any doubt on this? So now interpretation, we will look. One more important thing. Listen, here provision for doubtful debts should not be deducted from receivables. Why? Because here we are not measuring whether we are having sufficient amount of assets to pay the obligations or not. Here we are talking about how effectively we are using the resources. So provision for doubtful debts should be subtracted only while calculating liquidity ratios. While calculating other ratios, it should not be subtracted. Clear? Now, this is 14 lakh. Please change this figure. It is not 1,40,000. It is 14 lakh. Right. So now for this given figures, we have to calculate total asset turnover. What is the formula? Net sales divided by average asset. But here we don't have the information for average asset. We will just take the total asset. What is the total sales? Total sales, credit sales of 15, cash sales of 5 lakh. So total sales is 20 lakh. Clear? Any doubt in this? Total sales needs to be divided by what? Total asset. What is the total asset here? Calculate the total asset. 20 lakh. How much? 14, 15, 50, 60, 60 plus 21 lakh. Provision for doubtful debt should not be subtracted, right? But listen, don't write it. This is the wrong figure. I will explain it. Listen. This 21 lakh includes 5 lakh rupees of building which is under construction. Listen to this point carefully. Can this 5 lakh rupees of building, can you use this 5 lakh rupees of building for generating revenue? No. So this 20 lakh rupees of revenue is generated with this 5 lakh rupees or without 5 lakh rupees? Without 5 lakh rupees. So that 5 lakhs needs to be ignored here. Clear? Did you all understand this point? If you have any doubt in this, clear to everyone. Is there anyone who wants me to explain it? Why we are subtracting? 14 plus 150 plus 50 plus 5. Provision for doubtful debt should not be subtracted. That is sales, cash revenue, not cash in hand. This is not a balance sheet. We have to divide it by total asset. Right? Total asset is, you're asking how total asset? How 21 lakh, right? 14 lakh is the building, tangible asset, plus 150, plus 50,000, plus 5 lakh. Provision for doubtful debt should be ignored. Right. This 5 lakh rupees is not cash. This is cash sales. This is not a balance sheet figure. This is a P&L figure. Right. Did you all understand why we are subtracting 5 lakh? Is this clear to everyone? Any doubt in this? This 20 lakh rupee of revenue is generated without this 5 lakh rupees. Why? Because that 5 lakh rupee of building is still under construction. So this 20 lakh rupee of building is generated, 20 lakh rupee of revenue is generated without 5 lakh rupee, right? So this numerator, this 5 lakh is not included. So ignore it from the denominator also. That's all for consistency. Any doubt in this? Clear? Did everyone understand? So what is the total asset turnover ratio? 1.25 times. How do we interpret it? For every 1 rupee of asset, the company is generating 1.25 rupee of revenue. It means the company is making use of its assets effectively for generating revenue. Clear? Any doubts? Understood? Did you get 1.25? So next, capital turnover ratio. What could be the formula? Sales by capital employed. If average figures are given, mean if data is available for calculating average figures, we will take average figures. That's all. See, listen, this is slightly a difficult question, but just try for this question, try to calculate capital employed turnover. Just try it. However, I will also do it, but try it. Capital employed turnover. Well, I'm not sure. Capital turnover ratio. I'm not sure. Listen, listen, I will do it. Listen, listen. I don't think. Let me check. Listen, total sales is how much? Total sales. So capital turnover ratio. Sales is 20 lakh divided by capital employed. How did you calculate capital employed? 630 plus 1 lakh plus 150 plus 8 plus. That's all. What is the total you're getting? 16 lakh 80,000. Okay. 16 lakh 80,000 you're getting. Wait. This 16 out. Listen. 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 16 lakh 80,000 is the total capital employed. Out of this 16 lakh 80,000, 5 lakh is used for a building that is still under construction. So that 5 lakh rupees is generating any revenue or not? That 5 lakh rupees of capital employed is not generating any revenue for you. So that 5 lakh needs to be ignored. Till this point clears. 16 lakh 80,000 minus 5 lakh. Till this point clear or not? There is one more adjustment that needs to be made. How 16 lakh 80,000? Add everything except current liability. This plus this plus this plus this. That's all. 16 lakh 80,000. Capital employed means what? Equity plus preference plus debt plus reserves and surplus. Yes. You are asking why we are minusing 5 lakh. Which one? Where we are taking 4 lakh 80? We have to calculate capital employed, not total asset. Total asset minus current. I will do that. I will also show you how to do using that method. But for just 2 minutes, just listen. Did you all understand why we are subtracting 5 lakh rupees? You want me to explain it again or clear to everyone? Which four? Don't disturb the flow. First, did you all understand why we are subtracting 5 lakh? Is this point clear to everyone? Now listen. We are adding reserves and surplus of 1 lakh 50,000. The 16 lakh 80,000 includes reserves and surplus of 1 lakh 50,000, right? This 1 lakh 50,000 rupees of reserves and surplus is after subtracting provision for doubtful debts or before subtracting provision for doubtful debts? Huh? Before. After subtracting only, we will get the reserves and surplus. This is nothing but net income. This 1,50,000 is arrived after subtracting provision for doubtful debts of 20,000. But while calculating while calculating activity ratios, provision for doubtful debt needs to be subtracted or not? We should not have subtracted it, but this 1,50,000 we have subtracted. So add back the 20,000. Clear? Any doubt in this? The 20,000 part. This 1,50,000 is the reserves and surplus which we got after subtracting provision for doubtful debts. While calculating turnover ratios or activity ratios, provision for doubtful debts should not be subtracted. But that 1,50,000 is that 1,50,000 we got after subtracting it. So now we need to add it back. Got it? Understood now? So what is the capital employed? 20 lakh divided by, this is 17, 12 lakh, right? 1.6. Okay, 1.6. Except liquidity ratios, we will not subtract provision for doubtful debts anywhere. Why we are adding 20,000? Except for liquidity ratios, we will not subtract provision for doubtful debts anywhere. Only while calculating liquidity ratio, provision for doubtful debts will be subtracted. Now listen. Is this clear to everyone? Any doubt? Now listen, one more thing is there. I told you there are two formulas for calculating capital employed. One is adding everything. Other one is what? Total asset minus current liability. What is the total asset? 14 lakh. 14 lakh, subtract 5 lakh. So it is 9 lakh plus 150 plus 50. How much do we get? 1050, 11 lakh plus, so 5 lakh, 16 lakh minus 4 lakh. Same 12 lakh we are getting. Any doubt? You understood now the other way around? 12 lakh using other method. You did not listen now. No. You understood, right? The other way around. Total asset minus current liability. So did everyone understand? Capital of 12 lakh rupees. Any doubt in this? Right? You want a break? Okay. So listen, the next ratio is fixed asset turnover ratio. So again, since it is a turnover ratio, the formula will be, numerator of the formula will be sales divided by fixed assets. Right. So this ratio tells us how effectively we are making use of the fixed asset for generating sales. So calculate fixed asset turnover ratio for this. What is the sales? Same 15 lakh credit, 5 lakh cash. So total sales is 20 lakh divided by, what is the fixed asset of the company? 14 lakh, but which includes 5 lakh of building under construction. So this needs to be ignored. So we have to take only 9 lakh plus intangible fixed asset 3 lakh. So totally it is 12 lakh. But listen, accumulated depreciation on fixed asset is also given 1 lakh rupees. So it needs to be 11 lakh. So what is the fixed asset turnover ratio? 1.818. 818 times. Which means that for every 1 rupee invested in the fixed asset, the company is generating a sales of 1.818 rupees. So it means that the company is making use of the fixed assets effectively for generating sales. Any doubt in this? Clear? Next, current asset turnover ratio. Listen, before starting the ratio, let me tell you one thing. It is important to note that there is no direct relationship between current asset and sales, because sales is affected by numerous other factors. It is not just affected by the current assets of the organization. The demand means sales depends upon the demand in the market, right? So sales, there is no direct relationship between current asset and sales, since sales are influenced by other factors as well. So the relevance of this ratio is very much less. So current asset turnover ratio, the formula will be sales divided by current assets. This ratio tells us for every 1 rupee of amount invested in the current asset, what is the amount of sales the organization is generating. So for question number 22, calculate the current asset turnover ratio quickly. This ratio is not very much useful. It is of because there is no direct link between current asset and sales. 4.16. 250, 450, 5 lakh. So 20 lakh divided by 5 lakh. No, while calculating turnover ratios, provision for doubtful debt should not be subtracted. Just now we discussed. Only for liquidity ratios, it needs to be subtracted. So how many times? 4 times is the this thing, current asset turnover ratio. Clear? Any doubt in this? Did everyone understand? You understood? Understood, right? Next, working capital turnover ratio. What could be the formula? Sales by working capital. So for every 1 rupee invested in the working capital, what is the amount of sales the organization is generating? Calculate working capital turnover for this. Current asset will be 250 plus 2 lakh plus 50,000. Current asset is 5 lakh minus current liability is 4 lakh. Working capital is 1 lakh. What are the sales? 20 lakhs. So working capital turnover ratio is equal to 20 lakh by 1 lakh. We get 20 times. Clear? Any doubt in this? Did everyone understand? Right? So here, from here onwards, it is extremely important. Listen, because these ratios are going to be continued in the next chapter as well. That is working capital management, right? So if it see generally, if it is a turnover ratio, the numerator should be what? Sales. But only for inventory turnover ratio, the formula is cost of goods sold divided by average inventory. Only for inventory turnover ratio, we will take cost of goods sold as the numerator and not sales. Why? Because how cost of goods sold is, okay, first, inventory will be shown on the balance sheet or P&L. Inventory is shown as a current asset on the balance sheet, right? What is the relevant figure for inventory in the P&L account? What is that? Cost of goods sold is nothing but opening stock plus purchases of inventory minus closing stock of inventory, right? So the relevant figure for inventory in the P&L account is COGS. So we are taking cost of goods sold while calculating inventory turnover ratio. But important notice, in few questions in your study material also, it will be mentioned. They will just put inventory turnover ratios. They will open a bracket and they will say based on sales. In those situations, you have to use the formula sales by average inventory. If the question is silent, you can use cost of goods sold. We have. Clear? Any doubt in this? Because using cost of goods sold is the best practice. Why? That we will discuss in working capital chapter. We have two approaches, cash cost approach and total cost approach, that we will discuss later. Clear? Right? Now let's look at the interpretation of this formula. Listen. Let's say there are two companies, A Limited and B Limited. Let's say cost of goods sold of A Limited is 10 lakh and B Limited also, let's say it is 10 lakh. And average inventory of A Limited is, let's say, 2 lakh rupees and B Limited, let's say it is 5 lakh rupees. Now, what is their inventory turnover ratio? Inventory turnover ratio, how much? 5 times and 2 times. Now listen, how do we interpret this 5 times or 2 times? How do we interpret it? No? Please don't say for every 1 rupee invested in average inventory, 5 rupee, no. How do we interpret it? Exactly. Listen, actually this inventory turnover ratio, when you look at this ratio in isolation, this ratio, it doesn't tell us much. This inventory turnover ratio should be compared with another number, which is nothing but number of days in a year. Wake him up. This inventory turnover ratio should be compared with number of days in a year. For the sake of simplicity, let me assume the number of days in a year is equal to 360 days, right? Now, listen, when we divide this inventory turnover with the number of days, we will get something called as inventory velocity. So what is the inventory velocity of A Limited? 360 by 5? 5 to 7 times 72, right? 72 days and 180 days. Now, it is easy to interpret this ratio. Listen, A Limited can sell their, A Limited's existing inventory can be sold for next 72 days. But if they want to sell on the 73rd day, existing inventory cannot be used. They have to produce again. Clear? Or in other words, existing inventory can be used for sales for the next 72 days. Existing inventory will be cleared in the next 72 days. Right? For selling on the 73rd day, they have to produce again. Is this point clear? Any doubt? Similarly, for B Limited, COGS is not correct. Now, I'm not talking about COGS. I'm talking about inventories. Inventory means the goods. The existing goods can be sold within the next 72 days for company A Limited. But whereas for company B Limited, the existing goods will take 180 days to get cleared. You're all understanding it, right? Now, let me put it in this way. Day 0 to day 72 is one cycle. Similarly, 73rd day to next 72 days, how much? 144, right? Second cycle. So like this, if we go, there will be 5 cycles in a year. You're all understanding it? Any doubt in this point? Clear to everyone? Understood? Everyone? Right. Now you tell me which company is better, A or B? A, why? Because A Limited is able to push its inventory outside the factory at a faster, right? But for B Limited, it takes 180 days to push their inventory outside the factory. So A Limited is better, which means demand for A Limited in the market is higher than the demand for B Limited in the market. Is this point clear? Any doubt in this? Did you all understand how to interpret it? Those who came late also, you will be able to understand it with the next ratio. Right. Now look at question number 24. We have to calculate inventory turnover and let's calculate inventory days also, which is nothing but inventory velocity. Listen, cash revenue from operations is 1 lakh rupees. Credit revenue from operation is 3 lakh rupees. So what is the total sales of the company? 4 lakh. Gross profit is 25%. So what is remaining 75%? Cost of goods sold, right? COGS. And opening inventory is 1/3 of the value of the closing inventory. What is the inventory turnover? Closing inventory was 30% of cost of revenue from operation. Requirement is to calculate cost of inventory, calculate inventory turnovers. What is the formula for inventory turnovers? Inventory turnover is equal to COGS divided by average inventory. Listen, in this question, we have information for calculating average inventory. If it is not there, we can just take the closing value of the inventory. In this question, Since information is given, we will take the average value of inventory. So first, let's calculate the cost of goods sold. 30% of COGS. So first, let's calculate COGS, the numerator. Listen, the total sales of the company is 4 lakh rupees, out of which 25% is gross profit. So remaining 75% is cost of goods sold. So into 75 by 100. How much do we get? 3 lakh rupees is the cost of goods sold. Right. Next, we have to calculate the average inventory. In the question, it is mentioned that closing inventory was 30% of cost of revenue from operation. What is cost of revenue from operation? Which is nothing but cost of goods sold. It is 3 lakh. So closing stock is equal to 3 lakh into 30%. How much do we get? 90,000. In the question, it is mentioned closing stock is 30% of cost of revenue from operation, which is nothing but 30% of cost of goods sold. It is also mentioned that opening stock is equal to how much? 1/3 of the closing inventory. So 1/3 of closing inventory is 90,000. How much do we get opening stock? 30,000. Right. Now we have to calculate the average inventory, which is nothing but opening stock plus closing stock by 2. Opening stock is how much? 30,000. Closing stock is 90,000 by 2. It is 60,000. So cost of goods sold is 3 lakh. Average inventory is 60,000. Inventory turnover is 3 lakh 60,000 divided by how much? 60,000. Oh, sorry, 3 lakh. 5 times. You got it? Huh? Sorry? See, listen, if nothing is mentioned in the question, listen, if the number of days are not mentioned in the question, it is always better to take 360 days because 360 is divisible by 2, 3, 4, 5, 6, 9, so even 8. So it is better to take 360 days a year, not 365. Otherwise, you will get the answers in decimal. Huh? Average inventory. COGS is? No, 3 lakh. COGS is 30% of cost of goods sold. Sales 4 lakh. On 4 lakh, cost of goods sold is 75%. Because out of sales, 25% is gross profit. Remaining 75% cost of goods. Got it? So now what is the inventory velocity for this? How many days? Inventory velocity is equal to 360 by 5. It is 72 days. It is not, yeah, it is better to write it. So listen. Here, how do we interpret this? The existing inventory can be sold in the next 72 days. So listen, the existing inventory can be sold in 72 days, right? Is this clear? Any doubt in this? So this is how you need to interpret it. There are 5 cycles, which is nothing but day 0 to day 72, one time, 73rd day to 144 to 145 to, what is the next 72nd day? 216, third, then 217 to 8. This is 294. Okay, whatever you tell, I will write. I don't know. I don't have the calculator. 288. Okay. How much? This is 288 to 360. Correct. 72nd. 288 to 360. So these are all the 5 cycles, which is nothing but the inventory turnover. So 5 times inventory is coming in and going out of your factory. Is this point clear? Any doubt on this? Do you all understand? No. No, see, that's what I'm saying. If you take 360 days, you will not get decimals. You will get the whole number. If you are getting rounded to the nearest number, 72.1 means 72 days. 72.5 above means you have to write 73 days. Usually you will not get decimals if you are getting it rounded to the nearest whole number. That's all. Till this point, clear? Any doubt? So next ratio is debtors turnover ratio, similar to this. So again, here it is a turnover ratio, means numerator should be sales. But here you should not include cash sales, only credit sales should come. Why? Because you will have debtors only if you are selling on a credit basis. If you are selling on a cash basis, no debtors. So the formula is credit sales divided by average trade receivables. Clear? Any doubt? Only for liquidity ratios. So here also we have to calculate receivable turnover as well as receivable velocity, right? So question number 25, listen. Opening debtors is 15,000. Closing debtors, totally it is 60,000. But the 60,000 includes 50,000 due from a buyer of an old furniture. So this company is not into purchasing and selling furniture. This furniture is not their merchandise. So this closing debtors of 60,000 should not include this 15,000 rupees, because this 15,000 rupees worth of buyer is not a debtor for the company, right? Who's a debtor? Who mean if a person who's purchasing a goods on which you are trading on a day-to-day basis is a debtor. But here you have sold an old furniture and this is not your core business operating activity. So this 15,000 should be excluded. Is this clear? Yes. Any doubt in this? So now closing debtor is how much? Only 45,000. Opening bills receivable is 5,000. Closing bills receivable is 15,000. Opening provision for doubtful debts 1,500. Closing 4,500. Irrelevant. You don't need to subtract it. It needs to be subtracted only liquidity ratio. Total revenue from operation is 2 lakh. Cash revenue is 40,000. Calculate debtor turnover ratio. What is the formula? Debtor turnover. Credit sales divided by average receivables. Right. So first, what is the credit sales in this question? Credit sales is only 1,60,000. Question 25. Credit sales is equal to 2 lakh is your total sales, out of which 4 lakh is, 40,000 is cash sales. So remaining 1,60,000 is credit. Clear? Till this point, clear? Now we have to calculate average receivables. What is the opening debtors? 15,000. Opening bills receivable 5,000. What is the total opening balance? 20,000. Plus, what is the closing debtors? 60,000, but you have to exclude this 15,000. So it is 45,000 plus closing bills receivable 15,000. What is the total? 60,000 divided by 2. What is the average? 40,000. So what is the debtors turnover ratio? 1,60,000 divided by 40,000. We get 4 times. But this ratio standalone, it doesn't tell us much. So we have to calculate receivable days, which is also known as debtors velocity. Receivable days, which is also known as debtors velocity. So 360 divided by 4, how many days? 90 days. What does it mean? It means if a customer is purchasing goods from you today, he will pay you after 90 days. Right? Clear? Any doubt in this? How will you interpret the interpret what? That 4 times. Let's say there is one more person, A and B. Receivable days of A is, let's say, 60 days. B is 90 days. Sorry. Let's say inventory turnover is 6 times and this is 4 times. Now, what are the receivable days here? 60 days and 90 days. Clear? Now, for A Limited, the customers are paying within 60 days, so they are converting their receivables into cash quickly. But for B Limited, it is taking 90 days for them to convert their receivables into cash. Which one is better? 60 days is better. Which means that they are converting their receivables into cash at a faster pace. That is the reason why 6 is greater than 4. When you just look at this 6, it is very difficult to interpret. So it needs to be compared with the number of days so that we will get the receivable days. Right? So it refers to the speed at which they are converting receivables into cash. Higher the speed, lower the days, better the liquidity position. Clear? Any doubt in this receivable or turnover and receivable days? Clear? Now listen, payables velocity and payable turnover, exactly same interpretation, same calculation. You try to solve question number 26 and tell me the answer. You get the same answer. 72 days and 5 times. Everyone get 4 times on 90 days. Yes. Everyone done with this 4 times 90 days. Listen, you want me to explain this profitability ratio, gross profit, net profit? See, that we will discuss in payables management chapter. If you are paying them very late, your goodwill will be impaired. If you are paying your suppliers very late, your goodwill will be impaired. If you are paying them very early, your liquidity position will be bad. So you have to strike a balance between both.
போஸ்ட் டாக்ஸிங் சொல்லுதுல அப்ப வந்துட்டு இந்த இடத்துல பிஎட் அப்படின்ட்டு ஸ்டார்ட் பண்ணக்கூடாதுல்ல அது மேக் சென்ஸ் இல்ல அப்ப வந்து இது
Listen. Sorry? If nothing is given, yes. No sales return, nothing is less. Listen, gross profit. Listen, the final set of ratios. After finishing this, we can start with the questions. Listen. Profitability ratios can be classified into 2 types. One is profitability in relation to sales, and the other one is profitability in relation to assets or investments. So first profitability ratio is gross profit ratio or gross profit margin. So whenever the term margin is coming, denominator should be sales and numerator should be gross profit or net profit, whatever we have to calculate into 100, right? So in this kind of questions, sometimes gross profit will be not directly given. So that is something which we need to calculate. What is the formula for calculating gross profit? Sales minus COGS. So calculate COGS here. Subtract it from sales, we will get the answer. So what is the formula for COGS? Opening stock plus purchases minus closing stock. How much do we get? Oh, carriage is wages also there. Okay. Wages plus all direct expenses. That's all. Plus direct expenses minus closing stock. What is the COGS? 450 plus 450, 350, 430 plus 8. How much? 430, 17 plus 1440. 14,40,000. Did everyone understand how did we get 14,40,000? Right? Now calculate GP. What is the gross profit? Sales is cash sales of 24, credit sale of 20. So 24 lakh minus 14.4 lakh. We get 9,60,000. So what is gross profit margin? 9,60,000 divided by sales of 24 lakh. How much do we get? 40%. So how do we interpret this? For every 100 rupee of sales, 40 rupees is gross profit, remaining 60 rupees is cost of goods sold. Clear? Any doubt in this? Did you all understand? So higher the gross profit ratio, better it is. That's all. Nothing much to explain on this. Next, net profit ratio. Uh, Net profit, I have not included any numericals, but okay, fine. So listen, net profit, there is no numerical, but quickly we will discuss it. So net profit is also similar to gross profit, but net profit margin tells us the overall profitability of the firm. So it tells us for every 1 rupee of sales, sorry, for every 100 rupee of sales, what is the amount of net profit, right? So the formula is net profit divided by sales. COGS is 60%. Gross profit margin is 40%. Now operating profit, sorry, operating ratio. So the formula is operating profit divided by sales or operating profit margin. So look at question number 28. Listen, you don't do the full calculation. This is a continuation of question number 27. What is the COGS that we calculated? 14 lakh 40,000. Where we adjusted, opening stock is adjusted, closing stock is adjusted, purchases adjusted, wages adjusted. Carriage inwards we had. So carriage inwards is also adjusted. Now what we have to adjust from here? Bad debt we have to minus, interest we have to minus, depreciation and cash discount allowed. Don't subtract it from cost of goods sold. To cost of goods sold, it needs to be added. From sales, all these things needs to be subtracted. I hope you are getting the point, right? So what will be the operating expenses? COGS plus bad debt 6,000 plus interest payable 4,000 plus depreciation 240 plus cash discount allowed 10,000. What is the total? This is your operating expenses. 17 lakh. So operating expenses is 17 lakh. Did you all understand how 17 lakh? Huh? Oh, okay. Interest on bills payable they have given. Fine, but however, it will be subtracted before tax only. No? Interest on long-term debt or short-term debt. Interest is a tax deductible expense. It is subtracted to calculate EBIT, right? No, we are calculating operating profit. Correct. Oh, you're okay. Earnings bill. Okay. Got it. Interest on bills payable. Correct. So ignore this 4,000. Don't add it because we need EBIT. Correct. Then we will get EBIT. Which one? It is a finance expense. Interest of finance expense. So what is the operating expenses now? 14 lakh 40 plus 6,000 plus 240 plus 10. Sorry? Oh, employee benefit expense is also there. Even that is tax allowable only. Even add that 1 lakh also. 17 plus 1 lakh. So total operating expenses is equal to 17 lakh 96,000. So what is the operating profit? Sales minus operating expenses. Operating profit, how much? 74. No, operating profit. Total sales is 24 lakh minus 17 lakh 96,000. How much operating profit? 6 lakh 4,000. You're all following it. Clears? Any doubt in this? So now how do we calculate operating profit margin? 6 lakh 4,000 divided by 24,000. How much do we get? 25.16%. That's all. Clears? Any doubt in this? So now profitability ratios in relation to investment. Listen, I think yesterday also we discussed it. So for calculating return on asset, see, whenever we are having this term, whenever we are having this preposition on in between, the denominator should be the second term, numerator should be the first term. And the profit that we are taking, the return that we are taking on the numerator depends upon the situation. Listen, this is important. If the total asset is financed using 100% equity, what is the return that you will take? You have to take profit after tax. Suppose if the total asset is financed partly using equity and partly using debt, in that case, we have to take EBIT. Why? Because in second case, the denominator includes equity as well as debt. So the numerator should also include the profit that is available for both equity shareholders as well as the debenture holders. Clear? You're all getting it? Now this return on asset can be calculated either pre-tax or post-tax. So for calculating post-tax, we have two formula. This formula is always recommended because this formula is a better version, because if you are looking at this formula, we are taking EBIT and directly subtracting tax from there. But before subtracting tax, what do we need to subtract? Interest. So here interest is not deducted, right? So this formula is a better version where we take profit after tax, which is available to equity shareholders, and then we add interest, which is available to debenture holders. Clear? Any doubt in this? Did you all understand? Got it? Post-tax return on investment. Hey, what is your doubt? You ask here. What is your doubt? Say these two. See, from EBIT first you have to subtract what? Interest. But here, without subtracting interest, we are taking, we are just multiplying it with I minus T. In the first version of the formula, what we are doing? We are getting EBT, then we are subtracting tax, and then we are getting EAT, right? We are just taking this net income and interest. Completely, we are ignoring the tax that is paid to government. We are taking the earnings after tax available to equity shareholders and interest paid to debenture holders. Tax paid to government is ignored here, right? But here, this is not logically correct, because before paying tax, you have to subtract interest. That is not done. But here it is done. That is the difference. Got it? Did everyone understand? Right? So now return on asset ratio tells us how effectively we are using the asset for generating profit. In other words, it tells us for every 1 rupee invested in the asset, what is the amount of profit generated. So look at question number 29. So we have to calculate return on asset. It is not mentioned whether it is pre-tax or post-tax, right? So now what is the formula for calculating return on asset? It depends upon the capital structure. In this question, the company is using both equity as well as debt. So numerator should be EBIT divided by total asset, right? So you calculate the return on asset and tell me the figures. Here tax rate is given, so you can calculate both pre-tax as well as post-tax. What is the answer? Return on asset? 37.5 pre-tax, 26.25 post-tax. Did everyone get it? Okay, you are using the other method of PAT plus interest. Then 28.5 is correct. Even if you are getting 28.5, that is also correct. PAT plus interest by total asset. Did everyone understand? Did everyone get the answers? 37.5 pre-tax. If you are using this method, you will get 26.25. If you are using the first method, you will get 28.5. Clears? Did everyone get it? You got it? Now listen, return on capital employed, similar to return on asset. The numerator depends upon the source from which we are generating capital. If it is only equity, we will take profit after tax. If it is both debt equity, we will take EBIT. Clears? And same formula. Post-tax, you can use this or you can also use PAT plus interest. And one more note, listen, important note. While calculating capital employed, while calculating capital employed, intangible assets should be included, but fictitious assets should be excluded. Right? Because you're not raising finance for purchasing fictitious assets. like preliminary expenses or deferred revenue expenditures. But you can finance money for purchasing intangible assets like patents, right? So intangible assets should be included in the capital employed. Fictitious assets should be excluded. So now calculate return on capital employed for this. Listen, we are almost done. We are left with 1 hour. We can at least solve question numbers 37 and 38 today. It is possible. 37 and 38. We will see that. So what is the formula for calculating return on capital employed? Here we are using equity, preference and debt. So EBIT by capital employed. So what is the EBIT? You don't need to calculate. You know the number, 6 lakh. Because I have taken the same numbers. Divided by capital employed, how much? 150 plus 1 lakh plus 250 plus 8 lakh. How much do we get? 12 lakh. So how much? 50% is the return on capital employed, pre-tax or post-tax? Pre-tax. What is the post-tax? Tax rate is given? Not given, but assume 30%. Oh, here it is there. Okay. So what is the post-tax figures? You can use either this formula. If you are using this formula, you will get 35%. If you are using the other formula, how much do you get? 336K plus interest is how much? 120K divided by 12 lakh. How much? 46.3. 46.33. So if you are using this formula, you'll get 46.33%.
Oh, 38%.
38%. Clear? Any doubt in this? Everyone done till this point, right? Now listen, here we have to spend some time because we have some analysis and all under return on equity. So listen, everyone done? Listen. See, the formula for calculating return on equity is profit after tax divided by equity. So this is nothing but it tells, we have already done similar kind of calculation in capital structure chapter also, if you remember, right? So this tells us for the amount invested by the equity shareholders, what is the return that they are generating. Clear? Now listen. We will do one thing. First, just calculate return on equity on this. Using this formula, calculate return on equity and tell the amount. Then we will discuss DuPont mode. First, just calculate return on equity. How much you are getting?
112%.
Not 112. Everyone will make this mistake. Common mistake everyone will make. Net profit after tax is 3,36,000. But this 3,36,000 is not for equity shareholders because you have to pay preference dividend of 18,000. Right?
So that's 8.
So minus 3,36,000 profit after tax minus 18,000 to preference shareholders divided by what is the amount of equity? 1,50,000 plus 1 lakh, sorry. 1,50,000 plus 1,50,000, we get 3 lakh. Correct. No, that is we are calculating return on equity. We have already paid preference dividend to the preference shareholders. Apart from preference dividend, what is their expectation? You write it as average equity shareholders fund. Preference will not come. Where? This is after, not before. Because before interest and tax, it was 6 lakh. That is what we calculated in every question. This is after printing mistake. Clear? Any doubt in this? Better you can write the return on equity formula as profit after tax minus preference dividend by equity shareholders fund. That is a better way of doing it. Profit after tax minus preference dividend by equity shareholders fund. because then you will not forget preference dividend anytime. Clear? Huh? Question. So how many? 106%, right? Any doubt in this so far? Clears? Only equity. Preference dividend, it is already paid. Then what do they expect apart from that? Everyone done till this point? Clears? Listen now, let's see how to calculate return on equity using DuPont model. See, generally, what is the formula for return on equity? It is net profit divided by equity, right? Listen. Net profit into net profit divided by equity. This is the formula for calculating return on equity, right? But using DuPont model, what they are saying is, first they are taking net profit by sales. What is this? Net profit margin, which tells us the overall profitability of the company. Next, the second term is, here the denominator we are having sales, right? They are multiplying the numerator with sales and dividing it by total asset. What is this? Asset turnover ratio, which tells us the efficiency at which we are using the asset for generating sales. Clear so far? Now this numerator should be multiplied with what? Total asset. So that what will happen? Sales gets cancelled out. Total asset gets cancelled out. Net profit by equity. Right? But why we are doing this? Because DuPont model says that a company which has higher overall profitability and a company which is making effective use of its total asset for generating sales. And okay, first let me explain what is this third term. Listen, what is this third term? What? This is nothing but your leverage. How would this leverage? Because, or let me put it in this way, let me use the same term that is given in your textbook. This is nothing but your equity multiplier, which tells us the proportion of equity that is used for financing your total assets. Clear? What is the proportion of equity that is used for financing your total asset? Clear? Now listen, DuPont model says a company can generate more return for its equity shareholders if they are having higher overall profitability, if they are making efficient use of total asset for generating sales, and if they are using debt in the capital structure. Right? How it is going to work, you will be able to understand it much better only when we take numerical example. So look at question number 31. Question number 31, we will solve it using DuPont model. I will explain it. I'll explain DuPont model with this. This is a steady period question, so listen. So just apply the numbers in the formula. How much do we get? First, net profit. What is the net profit? 4326. Net profit. Sales. 29 into sales is 29,289. Oh, sorry, it should cancel out. No, correct. Sales by total asset. So 29,261 by what is the this thing? Total asset? 27,987. 27. Next, equity multiplier. 27,987. What is the amount of equity? 13,572. So listen, this first part is nothing but your net profit margin, which talks about the overall profitability. This is your asset turnover ratio, which tells us how effectively we are converting the assets into sales, right? Now, third part, listen, what is the total asset? 27,987. What is the amount of equity that is used to finance the total asset? 13,572. So what is that remaining amount? What is the amount of debt? 14 something. 14,415, right?
But I'll include current debt as well.
Hmm?
I'll include current debt as well.
Which one? What is given in the question? You are saying which one includes current debt? That 14,515. Assume it is long-term debt. That's all. Right? Listen, don't disturb the flow. Let me explain. So the total asset is 27,987, out of which 13,572 is equity funds, remaining 14,515 is debt funds. So the company is using more debt than equity or less debt than equity? More debt than equity. Just keep this in mind. Now calculate the return on equity. How much you are getting? 31.03%, right? Now listen, this first portion of the DuPont model is net profit margin, right? The company needs to take some sincere effort to improve their profitability, correct? The company has to really work hard to improve their profitability, right? Similarly, second is nothing but asset turnover ratio, which is nothing but the company should use their assets effectively for generating sales. Even for the second part of the DuPont, the company has to take some serious effort for generating more sales out of the asset. But when you look at this third component, here the company can use more and more of debt, and they can magnify their return on equity. It is possible. How? Because let's say in this case, 14,515 is what? Debt, right? Instead of 14,515, let's say the company is using 20,000 rupees debt. In this case, what is the return on equity? Huh? They are using 20,000 rupees of debt means, do you know, how much this is? 7,987. If they are using 20,000 rupees of debt, what is the return on equity? 27,987 is the total asset, out of which 20,000 is finance using debt. Only 7,987 is equity. In such case, what is the return on equity? How much? 3.5%. 52.75, right? So by just inflating the debt, the company can increase the return on equity or not? Listen, if you're not listening, I'm losing that flow, I'm losing that grip, then you will not understand. If the company is using more and more debt, they can magnify their return on equity or not, right? So here, currently they are using only 14,515 debt, where return on equity is only 31.03. But when debt is increased to 20,000, return on equity is increasing to 52.75, right? So they are magnifying their return on equity by employing more and more debt into the capital structure. For employing more and more debt into the capital structure, the company does not even need to take any sincere effort. If you can magnify your return on equity by just employing more and more debt, then anyone can do it. You're all understanding? For generating more profitability, the company has to work. For generating more asset turnover, the company has to work. But for this third part of the formula, the company need not work. They can employ more and more debt, and thereby they can magnify their return on equity. So what we are going to do is, now look at this analysis, you will be able to understand. A 31.03, okay, a 31.03 return on equity is good in any industry. Yet, if you were to leave out the equity multiplier to see how much company would earn if it were completely debt free. So what they're asking us to do is remove the total debt component. 14,515 is there, right? Remove this debt component and assume the company is using 100% equity for purchasing these assets. 27,987 rupees of equity is used for assets, for investing in assets of 27,987. In such case, what will be the return on equity calculated? So now what is the return on equity? It is 15.05 or 02. 04, okay, 04%. Right. Now, when you are not using any debt in the capital structure, return on equity is coming down. Now, read the theory, you will understand that if the company is completely debt free, ROE drops to 15.04 percentage, which is nothing but net profit margin into asset turnover ratio, which is 15.04%. 15.04 percentage of the return on equity was due to profit margin, which is 14.39, and sales turnover, which is 1.0455. While remaining 15.98%, this 15.98 is nothing but 31.03 divided into two parts. One is 15.04 when it is 100% equity. The remaining portion is there, no? 31.03 minus 15.04. How much do you get? 15.98. 31.03 minus 15.04. This 15.98 was due to returns earned on the debt at work in the business, which means the company did not work. The debt in the company worked for generating this 15.98 percentage of return. You're all understanding it? Is it clear to everyone? This 15.04 percentage is the return on equity that the company can generate without any debt, right? With debt, how many, what is the return on equity the company is generating? 31.03. 31.03, right? So 15.04 without debt. This remaining 15.98 came because of debt in the capital structure. So the company did not work for this 15.98%. Instead, the debt in the capital structure worked for the company to generate 15.98%. Clear? Any doubt in this? Did you all understand till this point? Any doubt? Oh. So that is the DFL, degree of financial leverage. If your upside is okay, let me put it in this way. If you are borrowing more money, you have to pay more interest. In that case, if you are borrowing more money, your DFL is more or less. More. DFL is more. With small increase in EBIT, you can bring a large change in earnings available to equity shareholders. That is what we discussed yesterday in DFL. Clear? I hope you are getting the point. In case of more borrowings, if the company is generating extremely high profits, it is beneficial for the company. That is what we discussed. Return on asset greater than cost of capital. Sorry, cost of debt. Return on investment greater than cost of debt. It is advisable for the company to take debt. Return on investment less than cost of debt. It is better to avoid debt in the capital structure. First point that we discussed in capital structure. You were absent on that day. No, that afternoon, Sunday afternoon, you were not there. Clear? Any doubt till this point? Did everyone understand what is 15.04, what is 15.98, and what is 31.03? Clear? Is there anyone who wants me to explain it again? Clear? Now read from here. If you could find a company at a comparable valuation with same return on equity, yet a higher percentage arose from internally generated sales, it would be more attractive. What do you mean by internally generated sales? Listen, understand one thing. There is nothing called internally generated sales. Can you sell goods to yourself? This is not internally generated sales. It is a printing mistake in your study material. It is internally generated funds. So what they are saying from here to here is, listen, let's say there are two companies, A Limited and B Limited. Return on equity is A Limited also, let's say 15%. B Limited also, let's say 15%. Now, which company you will invest? You are indifferent between both the companies, right? Because A is also giving 15%, B is also giving 15%. But let's say A is a levered firm, which means they are using debt in the capital structure. B is a unlevered firm, they are not using debt in the capital structure. Now, which company you will invest? A. Why A? 15% with risk or 15% without financial risk? Without financial risk. So you will choose B Limited. That is what they are saying here. If you could find a company at a comparable valuation, which means if return on equity is same for both the companies, with the same return on equity, yet a higher percentage arose from internally generated funds. Company B is generating 15% return from internally generated funds, which is nothing but equity. So it is better to invest in B rather than company A. Clear? Any doubt in this? Did you all understand? Now, shall we start with the exam questions? At least we will solve one question and then we can leave. What? See, listen, from question number 32 to question number 35, or sorry, 36, I'm ignoring. There is nothing in this. You know how to calculate dividend yield. What is the dividend yield formula? MPS by DPS. Then, sorry, dividend DPS by MPS. If it is an yield formula, the denominator should always be MPS. So it is MPS by DPS. Then here you have to calculate earnings yield. What is the formula? It is EPS by MPS. Then price to equity formula is MPS by EPS. That's all. Then dividend payout ratio. How do we calculate? DPS by EPS. That's all. Right. So I'm skipping all these questions. You can do it yourself. Which one? Correct. Oh, sorry. Clear? So far, we'll start with 37th question. Exam question. A bit lengthy question. Or else we will do one thing. We will solve 38 today. Because 37 is difficult and it takes time. We have only half an hour. We will solve 38 and 39 and then we can call it today. Right? Good. Can I skip it? You are doing the same question becomes, and what is the purpose of it?
Because we are writing numbers.
Okay, fine. So, X company has made plans for same number, same question. 37. Oh, this is difficult. However, we have to solve it in the class. We will do that. Listen, question number, or else you do one thing. If you are having it in the BCom, you have at least you have the practice of writing the numbers, right? So go back. Just I will do it in the class. Fine. Listen, question number 38. Listen. X company has made plans for the next year. It is estimated that the company will employ total asset of 8 lakh rupees. 50% of the assets are financed by borrowed capital at an interest of 8%. So, out of 8 lakh rupees of total asset, 4 lakh is debt, remaining 4 lakh is equity. The direct costs for the year are estimated at 4 lakh 80,000 and all other operating expenses are estimated 80,000. Goods will be sold to customers at 150% of direct cost. What is direct cost? 4 lakh 80, on which if you take 150%, you will get total sales. Tax rate is assumed to be 50%. Calculate operating profit margin. What is the formula? EBIT by sales. Net profit margin. Net profit by sales. Huh? In BCom. You are from which section? C section, I know. You are from B section. Okay. You know how to solve those who are already done. You know how to solve 39. 39. You try solving 39. Huh? We will do one thing. Everyone do 38th question itself. Listen. So, listen, third requirement, return on asset. Listen, in this question, they're asking us to calculate return on asset on operating profit after tax. What is the formula that you have to use? You can use two formulas, either by total assets or you can use PAT plus interest by total asset, right? Now, fourth requirement, asset turnover ratio, sales by total asset, return on owner's equity, net income by equity capital, right? So question number 38, we have to prepare the income statement first. Preparation of income statement. The first, sales. What is the amount of sales? Not directly given. Sales is 150% of direct cost. So 4,80,000 into 150%. How much do you get? 7,20,000. From sales, what do you need to subtract? First, subtract the direct costs. Then subtract other operating expenses. Direct cost is given 4,80,000. Operating expenses also given 80. How much do we get? I mean, what do we get? This is EBIT. What is EBIT? 360 and sorry, 240. How much? 160. From EBIT, what do you need to subtract? Interest. What is the amount of debt given in the question? 50% of total asset, which is 4 lakhs, right? So what is the amount of debt? What is the amount of interest? It is no, percentage is 8%. So 4 lakh, 8%, we get 32,000. You're all understanding how 32,000? So this is 1,28,000 EBT minus tax 50%, no? So tax will be 64 times. We get EAT as 64. So that's all, right? So quickly calculate all the ratios and tell me the numbers. What is operating profit margin for tax? 22.2%. Next, net profit margin, how much? 64 by sales of 7.8. 64 by 7.8. 8.8. What is aspect turnover return on capital? 0.9. Then return on equity 16%. So can someone tell me the final answers? $22.22 percentage, 8.89%, 10%, 0.9 times. Return on equity 16%. 16. Return. Did everyone get these answers? You want me to solve any of these requirements? Got it? Return on equity. Return on asset. Listen, return on asset needs to be calculated operating profit after tax, right? What is the operating profit EBIT? It is 1,60,000 is the operating profit, right? So return on asset after tax is equal to EBIT into 1 minus T by total asset. EBIT is 1,60,000 into 1 minus tax rate is 0.5. Total asset is how much given in the question? 8 lakh. Huh? That is also you'll get 18% something. Well, okay, correct. 64,000 plus 32,000 divided by 8 lakh. So here we are getting 10%. You understood now how to get it? Any other requirement that you want me to solve? Clears? Requirement 4 and 5. Did everyone get 0.9 times and 16%? Got it? Fifth one. Return on equity formula is PAT by equity. Profit after tax is 64,000. In this question, listen, total asset is 8 lakh, out of which 50% is debt, remaining 50% is equity. So 64,000 by 4 lakh, we get 16%. Got it? Shall we move to the next question? 39. You got it? Thirty-ninth question. You want to leave early?
CAI
At what time you have CIA? Listen, however, class is still 5:30. It's only 5:07. If you are... Listen, the thing is, 39th question, if I solve, I can give 40 and 41 as homework. That is the reason why I'm solving it now, right? To solve. We have. You want me to go to, you want me to go, you want me to increase the speed, but you're not allowing me to do that. Question number 39, listen. We will finish it in 10 minutes. I will completely solve it. You just listen. I mean, write down and listen. From the following ratios and information given below, prepare trading account, profit and loss account, and balance sheet. Right? Fixed asset is 40 lakhs. Closing stock is given 4 lakh. Listen, if closing stock is separately mentioned in the question, then in most of the cases, you will have information for calculating average stock. Stock turnover is 10 times. Then gross profit margin 25%. So remaining 75% COGS. Net profit margin 20%. Net profit to capital is 1:5. Capital to total liability 1:2. Fixed asset to capital 5:4. And fixed asset to total current asset 5:7. Now in this question, fixed asset is something which is directly given. So what should be your starting point? You can start the question from either of these 2 points. Fixed asset to capital you can start, or you can start from fixed asset to total current asset. Why? Because at least you have one value to calculate the other value. You're all getting it what I'm saying. Understood? So first, working note number 1, question number 39. Working note number 1. Since we are starting from this point, we are calculating total current asset. Working note number 1, total current asset. Fixed asset to total current asset is equal to how much? 5/7. Fixed asset is how much? 40 lakhs. Total current asset is something which we need to calculate. 5/7. So what is the total current asset? 28 lakh, sorry, 2 crore 80 lakh divided by 5. 5 times 56 lakh, right? Did everyone get this number clear so far? Now, we have fixed asset to capital. So we can do this as a second working note. Working note number 2, capital. Calculation of capital. Working note 2. Capital amount. Fixed asset to capital is how much? 4/5. Sorry, 5/4. So fixed asset is 40 lakh by capital is equal to 5/4. So how much do we get? Fixed asset to capital, right? What is the capital? 32 lakh. So far clears any doubt? Now listen, we have the capital figure. With this, we can calculate total liability. Right? So third working note, total liability. Capital to total liability is equal to 1/2. So capital is 32 lakh. Total liability is something which we need to calculate. Is equal to 1/2. So what is total liability? Next, we have capital, we can calculate net profit. So working note number 4, net profit. Net profit to capital is 1/5. Net profit is something which we need to calculate. Capital is how much? 32 lakh, right? One by 5. So net profit is 6,40,000. Till this point, you have any doubt? Clear? You're all following it, right? Now listen. What could be the next step that you can calculate? Net profit ratio is there. With this, what you can calculate? Sales. So working note number 5. Sales. So net profit by sales is 20% given. Net profit by sales is equal to 20/100. We know net profit as 6,40,000. So what is sales? By sales is equal to 20 by 100. How much? Clear so far? Any doubt? Next, what can we calculate? Gross profit. Because gross profit ratio is given as 25% of sales. Sales is 32 lakh. Working note number 6, right? Gross profit. I'm directly writing the amount. How much? 8 lakh. Did you all understand how it is 8 lakh? 32 lakh into 25%. Now, what could be the next step that we can go ahead? Any idea? Before that, what we have to calculate? We have to calculate COGS, right? So, working note number 7, or else you do one thing, wait, don't write a separate. Working note number 6, gross profit and COGS. So, COGS will be how much? 32 lakh sales, 8 lakh profit, remaining 24 lakh. You are all understanding how 24 lakh COGS? Did everyone understand? Clear? Now we have COGS. With this, what can we calculate? Average stock we can calculate, right? Working. With that average we can calculate. Working note number 7, average inventory or average stock. So what is the formula for stock turnovers? What is the formula? Stock turnovers? COGS by average inventory. So stock turnover is given 10 times. COGS is 24 lakh. What is average inventory? No, if nothing is mentioned in the question, it is better to take COGS. Average inventory is 2,40,000. Clear so far? Any doubt? Now listen, we have closing stock. We have average inventory. With this, we can calculate opening stock. So working note number 8, opening stock. Average stock 2,40,000 is equal to opening stock of 4 lakh plus closing stock of 4 lakh plus opening by 2. What is opening stock? Clear so far? Next we have nothing. Okay. Do we have all the relevant information for calculating P&L? Yes. Opening stock, COGS. Yes. Now we can do the trading account, trading and P&L account. Trading and P&L account. So trading P&L account, particulars, amount, particulars. So listen, first thing that we should write on the credit side is by sales. What is the amount of sales? 32 lakh. By closing stock, how much? Or else do one thing. Listen, you instead of writing by closing stock and all, you can directly write 2 COGS, which is adjusted for closing stock. Opening stock plus purchases. And because if you are going by the other method, you have to calculate purchase. No, instead of doing that, we can just finish it like this.
So that we don't find updates clear.
Yeah, if you are going by this, then it is not necessary. Correct. Or else if you want, I can do like that also. But in your study material, they have solved it like this. Directly COGS 24 lakh. I don't have the place to write it, so it is 24 lakh. Sorry. 2 gross profit, how much? 8 lakh. So 32 lakh, 32 lakh. Clear? Any doubt so far? Did you all understand? Now, this gross profit should be carried forward. By gross profit, how much do we get? 8 lakh. Now listen, we know the net profit. What is the net profit? 6 lakh 40,000, right? So what is this remaining 1 lakh 60,000? In your textbook, it is given as to other operating and admin expenses, but I think it is only given as admin expense, 2 admin expenses, which is a balancing figure.
Yeah, right. Other expenses will be there.
So it is your admin or other expenses, which is a balancing figure. What is the total of the balance sheet you are getting? Is it matching both the sides? Then it has to match, then it is wrong. I don't know. Let's check it. Let's check. Balance sheet as on 31st March. Assets and liabilities. So what are all the assets that we are having?
It says 40.
So first we have fixed assets 40 lakhs. Then take everything, separately show it. Stock 40 lakh, right? Sorry, 4 lakh. Next. Nothing. Huh?
Other challenge will be on that.
Oh, balancing figure it is coming asset side. Then write the liability side first. Liability we have what? Huh? Oh, okay. So other current asset 52 lakh. Okay, makes sense. Got it. So we calculated current asset in working note 2. Okay. So working note 2, balancing figure this is. Stock is 4 lakh. No. So balancing figure. So liability side, what do we have? I am not saying 96, only told 96. What is the liability side? Liability side, what do we have? What is 16 lakh? Capital 32 lakhs. Okay. How 16 lakhs? Net profit, they are not adding in the. Yeah, it has to be, but can someone check? I think they did not add it. Or else. No, in your textbook, I think they have not added. Anything else that we have on the liability side? Total liability 64 lakh. Then equity, anything like. Question number 39. So yeah, like I think that is the reason why they have not added it. Question number 39. So liability side. Listen, what they have. Okay, so listen, this capital excludes, this capital of 32 lakh is not included in the total liability. So what we have to do is total liability 64 lakh. So total is 96 lakh. Then we have to assume that this 32 lakh is your equity share capital. That is the reason why it is ignored from the total liability. I hope you're getting the point. What I thought was the total of the liability side itself is 64 lakh. Oh, it is 96 lakh. Clear? See, since since we are calculating all the missing figures, it is assumed that the net profit is included in the capital employed itself. This 32 lakh is inclusive of it. That is what we have to assume because in your textbook they have not added it. Not only in this question, in any of the questions they have not added it. Did you all understand how did we get 64 lakh? Clear? Listen before that. Listen. One minute. Wait. Listen. Huh? What? Yeah, we have directly written it. Listen. Question number 40. You can take it as your homework. Very simple question. Nothing in this. Question number 41. Oh, you don't do 41. 41 is difficult. We will do it in the class. 42, no. Listen, 43 is homework, and then these are easy. Okay. Listen, 43 and 52 are homework. We will not solve it in the class. Remaining question we will do in the class. Please try it and come. 42, sorry, 43 and 52.